Okay, this is Mike Swanson of Wall Street Window. And just 30 minutes ago, the Federal Reserve issued an FOMC edict. And as I'm doing this video, the Federal Reserve chairman is speaking live at a press conference. The Dow is down at the moment. It could go up on the close. Who knows? The NASDAQ was pretty heavy on the open. Gold is up. But these are gyrations, they can move the other way before the close. And I don't think this one meeting is going to have a meaningful impact at all in changing the overall trends of these markets. But there's not the stock market, that is, not gold. But I do think it's imperative to now take action when it comes to money market funds and interest-bearing securities that you may hold. We're really approaching a key turning point in those markets. And I think it's now time to get out of money market funds. Let me explain why, because when you understand why, you may come up with some ideas of what to do with that money. The suggestion is not liquidate all your money market funds because of this, what he's saying right here, and throw all of it into the stock market. It's not what I'm doing. It doesn't mean I'm selling my stocks. I'm not making any changes in with the stocks I own in regards to this meeting. But I am taking action with some other money I got in money markets. I just deployed a good amount of money I had in money markets into something else. So I'm trying to get I need to show you the statement that was put out, just the implications of the statement. And it's, it says, we want to get into the inflation rate to 2%. They're assessing the data, the evolving outlook, the balance of risks, and so forth. But the most important thing, period, is that in this statement, and I'm sure in what Mr. Powell is telling these reporters right now, there is no suggestion of raising rates even more. The Federal Reserve and various officials that came out after the last meeting that was held in December basically said, we're not raising rates. So therefore, ever since the December meeting, the question in the mind of market participants has been, when will the Federal Reserve lower interest rates? And as this year began, the odds were in the Fed Fund futures market of a cut in March. Now, those odds have vastly diminished. They were falling into this meeting, into this statement and press conference that we're witnessing live, but now they're almost, at the moment, almost zero. There's still a good chance of one in May. And if it doesn't happen in May, it'll be in June. And maybe it will happen in March. Maybe there'll be some negative economic data that justifies March cut. Not now, though. But what is important to realize, the most important thing to know, is that the next move that the Federal Reserve makes when it comes to interest rates is going to be a cut. It's not going to be an increase. And you need to think about that. What does that mean for your investments? What are their stocks? People have been front running it for weeks. But what about money markets? What it means is that when the Federal Reserve does start to lower interest rates, the amount of money you're making now on money market funds will go down, and it will not go up higher now than what you're getting. You're not going to make more money on your money market next month than you are now, but in 2, 3, 4, 12 months, you are likely, almost certain, to be making less. What that means is that yield on your money market is going to go down. It's not going to go up anymore. It's going to go down. And so I think the prudent thing to do then is to lock in those yields, to sell the money market, move that money into bonds, CDs, or possibly bond funds, and that can get you a higher yield even than what you're currently getting in your money market account. Many millions, really, of stock traders, investors, individuals in the United States sold stocks and put that money into money market funds a year ago or 2 years ago, and it's been sitting there, and they've been happy to see that, get 5% or even more out of that. In fact, there were people that had bank accounts just in cash that, savings accounts and so forth, that move that money into money markets on online brokerages just to get the higher yield from those money market funds. But what I'm telling you is that the yield is not going to go up anymore. And at some point soon, it's going to go down. And they may not go down in March, but it's likely to go down in May, if not March, if not May, certainly by June. And that's the most important takeaway from this meeting. And let me show you what this means. For instance, for CDs here, this is the yield on a 1-year Treasury bond. Notice that the yield was 4.3% in March, and then it went all the way up to 5.5, and that's what the federal funds rate is. The Federal Reserve rate is currently in the 5.25, 5.5 range. The yield on the 1-year Treasury bond, though, has gone down, while the yield that the FOMC sets is still up where it was in October. At some point, that Federal Reserve Fund yield is going to go down. The FOMC yield is going to go down. They're going to move the yields down to follow what's happened with this yield. And yes, right now, you're likely getting 4.8, somewhere between 4.8 and 5.25 on your money market funds, but it's going to go down too. It's going to go down with this chart. And when these yields go down and the Fed starts to lower rates, they can go down even more. So lock in those yields while you can. Now's the time to act. I know there's a lot of people that, they don't understand that the money market yields move up and down. They saw that they went up. They found out that they went up, and they put money into them, move money into them out of their bank account into brokerage accounts, but they may not be thinking about that the yields are going to go down. And the reason I'm doing this video is to let people wake up to that fact and that reality. All the implications of this meeting that he is saying are that, we're not raising rates today, but we will in the future lower them. But we're looking at all this data and this and that factor and so forth to make people that are very active in the markets to think, well, they're not going to do it in March. Okay, but they will do it. That's going to be the next move. And you want to position yourself ahead of that, because if you got a money market fund and the Federal Reserve lowers interest rates and then you move the money out into something else, it's too late. Now you got to do it before the rate cut. That's why I think you should do it now. That's what I've done today. I took money out of a money market fund and bought a bond ETF that is paying over 5% interest. I've also, got a lot of money in CDs, individual corporate bonds, and so forth. But I'm getting out of money markets, getting out. I think that's the trade to make now. The Dow goes up and down. What it does isn't that important on today. I don't think it's going to be a meaningful move, not necessarily a meaningful move for gold, but I think what is clear is the clock is ticking for the people that want to get ahead of the day that the money market yields decline. Why? There's no reason to wait. Get ahead now. And you get more yield anyway. You can get more interest than your money market is paying just in CDs. Do it. Talk to your investment advisor. If you don't have, if you're not used to doing these things yourself and you got an investment advisor, talk to them about this. But do something. I think now's the time to act. And that's what I've done myself. Even before the meeting today, this morning, as soon as the market opened, I moved out of my money markets. And so anyway, if you like this video, if you want more live analysis from me that's actionable on what is going on in the markets and what it means for you, hit like. And to get my next video, hit the subscribe button and hit the bell next to that, and you will get an update from YouTube as soon as